Welcome to Sachs Realty's Tuesday night podcast, where we talk about anything and everything real estate. Each week, we deliver expert information enabling you to make better informed decisions while keeping more money in your pocket. If you're interested in real estate, this is your show. All right, we'll see how many real followers we have here that's watching us instead of the DNC. And I'm not drawing any political lines. I'm just saying that I'm up against some heavy competition tonight. But hey, here we are. We are live, and we have some great guests sharing the screen with me tonight, and we'll kind of dive into that here. But anyway, guys, welcome to our live show. If you have any comments or questions as we go through the information, go ahead and comment them. I'm in the office and not in the studio here tonight because Joe, we gave him the week off. He's our producer. He's enjoying some vacation time, but he is tuning in and still helping us behind the scenes. But tonight we're going to talk about mortgage rates. It seems that with all the politics happening and going on, that with the housing market being probably at the top of everyone's agenda to talk about, because we know the unaffordability over the last 4 years and the home prices, the way things have really skyrocketed, has made a lot of people very upset that they can't afford to buy a house. They're having a hard time affording their mortgage payments, and they're really having a hard time even renting. And we know over the last 4 years, millions of millennials especially have moved back home with mom or dad. And that's kind of not cool. You know, if you're 30 years old, 32, 34 years old, and you can't afford, I mean, you think about it, when you get to a certain age, for me, it was really young. You get out of the house, you don't really want to go back necessarily. You want to start your life. And when you graduate college or you're out in the workforce and you're in your 30s, you probably don't even really want a roommate unless it's partner, significant other. It's kind of not cool to share an apartment at 35 with friends. Some people are doing it, but I don't believe that the masses really want that. They want to be able to do well financially. But we're going to talk about what's in the news lately, where mortgage rates have been dropping ever so slightly, but they have been going down. And what many people believe that could possibly, prevent a housing market crash. We are in a crash now. We're seeing price reductions and days on market increase. Not every place, but in a lot of the major markets around, it is happening. But we're going to talk about, Pam's going to be with us. She's in the mortgage industry. I'm going to introduce them in a second here. But I want to say a couple things, some housekeeping things, just to bring us up to date. We've been finding that not all of our subscribers have been getting the videos that we've been publishing. And for whatever reason that may be, whether they're being held back, I won't use the word, but we do talk about a lot of issues that mainstream media doesn't want to discuss. In fact, nobody seems to want to talk about it, but we are bringing it to you guys, some great guests. And so we have now realized that there may be a reason that we need to start grabbing your data so that we can send you information directly by email. So I have dropped in the description below this video. I don't know how easy it is to see when we're live. Never looked, but it is there. We do not share your information. I would never share your email address, but give us your email address. I gave you the link to our website. It goes straight to our CRM, so that we can start, when we post videos, that we can send you just a little reminder that, hey, we just published a video, in case you're not getting it through the algorithm. Hint, hint. So that's number one. Number two, another thing that we're going to be doing here is posting on more on LinkedIn and X. So we want to try and start to really preserve our audience and expand And just to let you know, we are now on every major audio platform that there is: Spotify, Stitcher, Pandora, Apple, Google. So you can now take us, because we're a long form platform with our interview style, and we try and bring a lot of good relevant information to you. It's not easy to do in 10 or 15 minutes, but now you can take us for the drive in the car with the audio platform. You can also take us on the treadmill, or however you want to do it. Speaking of treadmill, if you want to follow me, I'm going to be. I need some help, guys. I'm started working out again, and guys, I need some accountability partners. So you could reach out to me about that too if you want to follow my progress. I'm going to try my goal. I don't even want to say what my goal is, but anyway, that's enough of me. I want to introduce our guest to bring us the latest in the mortgage industry. We are going to go to Pamela Vroman. She is one of our referral partners. You can find her on our website. But Pam, real quick, just a quick introduction of why people should pay attention to you. Why should they listen to you when you're giving mortgage advice?
Well, thanks, Todd. Thanks for having me. So like Todd mentioned, I'm a loan officer, have been in the mortgage industry for 23 years. So I've seen the ups and downs of the market. Currently based in Maryland near Todd, and have worked for my company for about 12 years. I have a small branch of direct mortgage loans, and hope that you find some of the information and feedback that I give you today educational. So thanks again for Todd. Thanks again for
That's
having
quick.
me.
So just for clarification, when you say that you've been in the business for 22 years, that predates the GFC. So that's what we need to pay attention to tonight, guys, because Pam has been there, went through it along with me. And Rod, you as well. Rod, go ahead and introduce yourself. You're an agent. You're also in our referral network, one of our preferred agents in the country. And you're in Colorado Springs, Colorado. But go ahead, introduce yourself.
You just covered it all for me, Todd. That was it.
Quick introduction.
No, yes, I'm an agent here in Colorado Springs. I cover Colorado Springs and Denver. I've been in the industry since 2007. That's when I first got started. Um, yeah, so I've seen that downturn, experienced the upturn, and then got my license as a realtor in 22.
Well, you were in the business in 2007, so we can blame you for the crash. How was that? you got into business just whenever. But if you were investing back then, you had some fun days. There were some good deals out there.
Yep.
But yeah, let's go ahead. We'll start off. Pam, we're going to start with you. We only have you for an hour tonight, and Rob, we have you through the duration. So, guys, if you have any questions, mortgage questions, hearing some feedback. Is that anybody hearing that feedback?
Is that me? It's raining here. Let me see.
Oh, is that what it is? Oh, there we go. Yeah. We'll mute him. Man, it's pouring down. My gosh, that's like, man.
Wow.
Anyway, we're going to start with the mortgage side of things because, like I said, Pam she's going to jump out on us here in about an hour. But I have an article here that I just want to bore you all with reading the entire 650. I'm kidding. But here's the mortgage interest forecast for the fall of 24. Well, congratulations, CBS News. You're one of the mainstream media outlets that you're going to tell us all what things are going to be like here in the fall. Maybe you'll tell us who will be elected come November. But what I want to focus on here is that they are predicting that mortgage rates, Pam, are going to continue to fall. And in fact, it says if economic data continues to show the economy is cooling off and inflation is getting under control, then most economists, I'm reading right here, most economists expect that the Fed will begin a series of rate cuts, which will cause mortgage rates to gradually decline. And Pam, the first thing I really want to talk about is, how can we consider what the Fed does will affect? I mean, why would we say that when the Fed cuts rates, which has nothing to do with mortgage interest rates, how can we assume that a Fed rate cut or a series of cuts will affect mortgage rates?
So I think that stems from, obviously, mortgage companies, when they're lending their money, they're basing it off of what they're borrowing against. So that's where the mindset comes in. However, I think we have probably already seen the September cut, or most of it, baked into the rate drop that we already have experienced. So I don't know that in September we will get as much as we all would like to see. However, I think, the Fed will continue to cut rates past the fall. I just don't know that in September we're going to see a huge decline.
So you're saying that what rate drops we're seeing now are already baked in to the expectations there. So people are kind of getting in front of the curve here, trying to grab as much business as they can now,
Yeah.
to take advantage of that extra, month of business potential, thinking that the Fed is going to cut what, a quarter or a half a point. What are you expecting?
Yeah, I would say probably a quarter is what I've heard. I've never, claimed to be an expert, but in my experience, when the Fed cuts rates or raises rates, it usually is baked in. Our rates don't go up immediately that day. It's usually kind of already forecasted in, because just like you're kind of predicting, we kind of already know what they're going to do. So they're already planning ahead most of the time.
A lot of people think that if rates drop, I mean, we're experiencing a major difference in the housing market. I mean, we're seeing inventory at pre-pandemic levels right now, which is, I mean, it's crazy. I have a slide here that I can show you. And, a lot of people are saying, well, if they cut rates, it will only cause home prices to go back up, or to start to rise again. So,
Sure.
what are your thoughts on that? If we look at this chart here, okay, this chart is telling us of July. Now, the housing market is always backward-looking data. So when we look at this chart as of July, we're seeing inventories that are really dating us back to, right at the pandemic. Right now, in August, we're almost at the end of August, and we are above pandemic numbers. So this trend line has continued to incline. What do you think would happen? I mean, are rate cuts? First of all, what are you expecting? I mean, what do you think by fall? Where are mortgage rates right now that you're seeing this week, and where would you expect them to be by the end of this year?
So if you don't mind, I'll start with where we were about 2 weeks ago. So we were in the low sevens about 2 weeks ago, and now we're hovering around mid sixes. Now, one thing I would say about interest rates is that they are a broader range than ever. So there are so many different factors that go into interest rates. So, for example, one particular client could price into the high fives, where another client could be into the high sixes, depending on credit score, property type, debt ratio, down payment, income. So there are more variables than ever that go into pricing, but around mid sixes is what we're seeing right now. We were in the low sevens about 2 weeks ago. I would say by fall, maybe pushing into November, that those decline maybe another eighth or quarter, but it's truly hard to predict. I've never really focused and tried to be an expert of rates, because if I were, I probably would be retired by now, because I would have predicted what happened during COVID and we'd all be on a beach somewhere. But I think we'll see them continue to decline. I don't think it'll be as much as we would all like in 2024. I think 25 will get even more of a decline, and then that's when we'll really see how things pan out in the market and heat up.
Do you think we'll ever see under 4% at 4 or under 4% again?
I don't think that we'll see that in the foreseeable future. I think that there'd have to be something like the pandemic to put us back there. I don't see that happening. What do you think? I don't think we're going to see those type of rates. And in fact, I think that our point of reference is skewed since COVID because, 5 years ago, 5% interest rate, 6% interest rate is kind of really more your norm. So we're kind of getting back to a normal level. And those pandemic rates were just, astronomically low.
Yeah. I mean, I interviewed a loan officer. Let's see, we're in 24. This was in the end of 22. And we had just come off of massive rate hikes, fastest rate hikes ever in the history. The Fed, accomplished, started in March of 2022, and it was pretty much a straight up line of rate hikes. A lot of people, including myself, think that not raising rates a year prior will probably go down as one of the biggest mistakes the Federal Reserve has ever made. But they did allow for home prices to go up 40% in a 2-year period, which is terrible for consumers, even homeowners. I mean, people want to think that it's great that their home values went up until their HVAC breaks, and it's now costing them $30,000 to fix it instead of $7,000 or $8,000 to fix it. So everybody's like, yay, my home prices skyrocketed. But until, like I said, they get a roof replaced, and it's $40,000 to replace a roof instead of $8,000 or $9,000 or $10,000 to replace a roof. So this is no party for anybody by any stretch of the imagination. But you ask what I think. So when I interviewed at the end of 22, this loan officer, she said that rates would be back at 4% in the spring of 23. And I said, you're crazy. You'll be lucky if they're under 10. And I said 8%, and that's where they went to. And I'm not saying that I'm a genius or excellent. And I predicted it, but I can't take the rest of my life to a beach. So I don't know, Pam, that if you're even right at predicting these things, whether that'll net you any money. It may get you a couple more subscribers, but it may not mean anything to your bank account. But I think no, I wouldn't put anything past them. But we would have never had 4% mortgage interest rates had the Fed not started buying mortgage-backed securities in 2012.
Right. Exactly. Right.
They were the ones that artificially lowered mortgage rates.
Exactly. Yeah. Yep.
Let's talk about what the difference means in payment.
Okay.
So what does a 0.5 percentage point mean to someone per thousand in loan balance? So a 0.5 percentage point. Now, obviously, we can't predict insurance if they're in Florida or Louisiana or someplace where, property insurance has gone to $25,000 a year. But just on principal and interest, because everybody's tax payments and insurance payments are going to be what they are.
Right. Yeah. So let's give just an example of 10. So for $10,000 in mortgage, if rates are currently at 6.5, you'd want to think of that adjusting the payment about $65 per month.
Not a big deal. Right?
Not huge. So we've seen rates go from about 7.25. So the example that I kind of worked up, we saw rates go 7.25 to 6.5 on a $300,000 loan purchase price with 20% down. That's about 120 we've seen buyers pick up with rates declining recently. So,
Yeah.
you know,
So
it
that's
hasn't
not,
affected the market that I've noticed yet.
yeah. Rod, what do you think? Do you think that's a big deal? Do you think dropping, I mean, all of this touting about mortgage rates declining, you think that's going to have any impact at all for home prices?
I really don't think so. It's kind of like Pamela was saying, where that difference is, $250 over the course of a year and $20 a month. That's not going to make a huge difference for a family. It's just not on top of groceries and things like that. It's not going to make them decide, it has dropped down to 6.5. Now I'm going to go out and buy a house. So I don't see it making an impact, and I have not seen it make an impact. Um,
Yeah.
yep.
Yeah. Where
Yeah.
would mortgage rates have to get to stimulate or help buyers with today's home prices?
Me or Pamela?
Pam.
So I think part of interest rates is a little bit of psychology to it. I think that getting into the fives, it may not necessarily, like Rod shared, have a huge impact. Like I look at my grocery bill and I'm like, gosh, that's like not a lot in compared to the cost of other things. Like, $120 a month in savings, $240 a month in savings seems nominal compared to other expenses that we're all incurring. So I don't know that it necessarily will be what dollar amount, but I think that when we get into the mid to low fives, psychologically people are like, okay, I'm finally willing to come off of my 3% interest rate because this isn't that bad. I know for me personally, we've thought about moving as a family. My interest rate, I think, is 2.5. I got it during COVID. And I'm like, if they got into the low fives, I may be willing to loosen my grip off of that rate to make the move. But I really would have to find the right property. So I put myself in the shoes of other buyers. And I think that there is a pent up demand for people to make that move. I think that a lot of people bought during COVID and family dynamics have changed. They're not working from home as much, yada, yada. So I think that pent up demand will loosen, I think, if we get into the low fives, not necessarily because of the dollar amount, but also because of that psychological, the sound of 5.25 versus 6.5, if that makes sense.
So
Yeah,
I
well,
have
you
a
said sellers. Go ahead, Rod.
So I have a question to kind of piggyback on what you were saying. So I guess it's a three-part question. So for people out there that might not know, can you explain a 2-1 buy down?
Yeah,
Sure.
before she
So,
does that, if I could just jump so I don't lose this train of thought,
Mhm.
because that'll take us down a different road. But based on your math, a $500,000 loan balance is going to save somebody $62.50 a month if their 6.5 rate goes to 5% based on your math. That's $62.50. That's what, $750 a year. That doesn't seem like a whole lot of money to me to get somebody at 5% from 6.5 with a $500,000 loan balance. But you said you put yourself in a position as a seller, saying that might make you sell because you won't feel as bad being at 5% if you have a 2.5% loan, but that would just probably add inventory to the marketplace. But I guess where I want to go with this thing, to Pam, and we're going to dive more into it, is can that save home prices from finally crashing? And, when I'm looking at $62.50 a month to a person that has, credit card debt, an auto loan, groceries that they can't afford, to me, the answer is we are still on the same track because the exuberance is gone. The exuberance
yeah.
is gone. The insanity, the crazy thinking that I have to buy a house no matter what. And I have to borrow money from mom and dad, not borrow it, but get gift money from mom and dad, in order to buy a house. And that's all cooled off, has it not?
gift money and things like that?
No, just exuberance, that I have to have it. Like, just making the crazy decisions that they were 2 years ago.
I think every situation is different. I will say personally, I have a mixed bag of clients. I will say some of that, what you see when you have so many competing offers where people are going so much over, I haven't seen as much of that type of exuberance. So I think that is cooled off.
I guess the question, that wasn't fair to ask you because you see it after, and a lot of times after it goes under contract. The real question probably will be for Rod, because he's the one like myself that sees where, there has been, I mean, it was just a Redfin report in, I don't know, was it the month of June or something? 60,000 contract cancellations or something like that. People walking away from their contracts at record numbers, the highest number ever. I think it was June. It was the highest number in June, I think, in tracking. I could be completely screwing this up, but I know it's a lot. And we've seen it. We're seeing contracts falling through like crazy. But Rod, do you think that, are you seeing the exuberance that you saw 2 years ago?
Not really. What I'm seeing is a lot of that. That's why I was asking about the 2-1 buy downs, because what I'm seeing is a lot of that, people needing that and requesting that in order to purchase, and that's bringing their rates down to that 5.5 or something in that range. But I'm not seeing people, I'm not seeing the people just jumping for joy to purchase a house right now. I'm not seeing it. I see people trying to, and I see that they're not getting qualified. They like you were talking about earlier when you start the show. You don't want to be 35 years old staring, staring, in a place with a bunch of people. So people want to, and then they go out and try to get qualified, but then they're not. I can't tell you the amount of calls I've gotten from people, and I send them to a mortgage broker, and they're not qualified.
So Pam, go ahead and answer his question then.
So you had asked about the 2-1 buy down and how that works, right, Rod?
Yep.
So the way a buy down works is, first of all, it typically needs to be paid for by the seller. So the seller is technically paying to buy down the buyer's interest rate 2% for the first 12 months. So let's say, for example, right now interest rates are at 6.5. They would be buying it down to 4.5% for 12 months. 5.5. And then for the remainder of the loan, 25 months and beyond, it goes to the market rate at the time when they locked in, which as of today, like we mentioned, is about 6.5. Feature of a buy down is that they're unused. Let's say, for example, they refinance in 12 months. Any of the funds that are sitting in this escrow to buy down the interest rate can be applied to the principal balance. So you don't lose anything if you do refinance before the 24 months is up, if that makes sense how I explained that. But that's the gist of a buy down. It comes from the seller and is a way to kind of put a Band-Aid on interest rates temporarily. And what I talk to for buyers, if they have this option, is thinking through how long they're going to be in the loan, how long they're going to be in the home, because we don't want to bank on what rates will do. And I always want to make sure they can truly afford the property after that first 24 months is up.
Are you seeing a lot of people having a hard time getting qualified now, Pam? We've seen credit tightening.
So, I think of someone I spoke to today, kind of a colleague in the industry looking to purchase her first home, salaried wage earner. And I asked her how it was going. I have her pre-approved, but not for an amount that's going to get her a substantial home in the Baltimore metropolitan area. So I asked her, I was like, how's it going looking at houses? And her comment was depressing. And I was like, I feel for you. I feel exactly where she's coming from to get the numbers to work. It's funny because we're exactly talking about what she's doing. She's in her 30s. And I had just pre-qualified another client who was a roommate looking to now buy her home. And I was like, well, have you considered getting a roommate? That could be a way for you to purchase. And she's like, you know what, Pam, I think I am going to move near this college and consider that area. It's a little more affordable. She's in her 30s. Maybe she can get, a graduate, somebody that's, going for their graduate degree to move in, someone more mature, because she really does not want a roommate, but that's what purchased early on. So I think a lot of people are considering creative things like that. We also talked about her having a traveling nurse in a finished basement. Just a lot of creativity is happening in the market, I think, to make things happen. So you touched on exactly what I see often. But you're right. Yeah, a lot of people don't qualify for the home that they want. So they're looking at $500,000 homes. However, they qualify for more like a $300,000 home. And that's where they also want their payment as well.
Are you seeing credit card delinquencies going up?
Yeah, I actually, so with the drop in rates, I've reached out to a few clients who I've closed in 23 and 22 when rates went up to see if I could, capitalize on some savings for them. And absolutely, people are definitely struggling. The one client that I spoke to maxed out credit scores were so low that I unfortunately could not help him. So I'm seeing a lot of that. And the other thing that I'm also seeing out there are extremely high car payments. So, an average car, 30, 35,000, those car payments are astronomically high. So that's another part that I see playing a big role in helping borrowers try to get qualified.
In the current Fred data, it is showing that as of August 7th, we've gone back up in credit card debt and revolving debt. We're over $1 trillion in credit card debt right here. This is measured in billions. So we did see where there was a little dip, that everyone was bragging about here in June. And now we're seeing, the credit card balances skyrocketing again. So when you're going back on some of these following up, you're seeing where their credit card debt has increased.
Yes. And, some of them are having to pull from 401ks. I think I read a statistic that 401k hardship withdrawals is the highest that it's been in a very long time. So again, people are trying to get creative to get by. Credit card debt and being maxed out, taking 401k withdrawals, having second jobs. I think I see it more of that than ever as well. So people having like these gig jobs on the side is also super common to try to compensate for inflation. And
we can look at delinquency rates here over the, this is the last 5-year delinquency rate chart on credit card loans alone. You can see is really gone up well over pre-pandemic. So, are you thinking that this trend line is going to continue? You think it's going to become harder for people to continue to pay their credit card debt?
Yeah, I don't see this. I don't see this going away anytime soon. Not unless something gives here. I can't see anything that would make this change in a positive direction in the near future.
Yeah. I want to bring our poll up. We have a poll out there. We wanted to ask everybody what they thought, whether mortgage interest rates, if they decline, I want to bring our would that up. We have a poll out there. We prevent ask everybody what they thought, whether housing market crash, if they decline. I want to bring our would that. We have a poll out there. We prevent ask everybody what they thought, whether housing market crash, if they decline. I want to bring our would that. We have a poll out there. We prevent ask everybody what they thought, whether housing market crash, if they decline. I think adding this has made a massive echo, Joe. What they thought, housing market crash. I think adding this has made a massive echo, Joe. Housing market crash. I think All right, 66%. Oh my gosh. This is what happens when Joe takes a vacation. We're never letting him do that again. I'm kidding. But I think he was sharing the YouTube channel live and it was replaying it over and over and over again. But we have a poll if you want to go over. I promise I won't bring you back to that poll. Basically, people don't believe it. They don't think that this is enough. In 2007, the Fed dropped the rates and it did not. Here we go. We figured it out. Thanks, Joe. 605 votes. Can lowering mortgage rates prevent a housing crash? 66% of you says no way. I think that we're seeing that all over, right? All over the country, where we're seeing price declines and things like that. Pam, do you have any questions for Rod or myself before we go to the questions that we have here for you?
I guess I would say, what have you guys experienced? I feel like I've noticed since July, I've felt a cool off in the market significantly. Ever since we had a week here, Todd would remember, in Maryland, where it was like 100 degrees. I feel like after that, our market seemed to cool. Have you guys seen the same thing? And I haven't noticed that interest rates have had the impact for that things to heat up, but I also think we're probably experiencing some seasonality where, maybe September will turn things around after everyone gets their vacations and back to school wrapped up. What have you guys experienced?
What I've seen is we've been cool, since 22, and it's been a slow grind. We might have some upticks here and there, but when you look at the overall sales that we've had since 22, it has been just, down.
Well, Pam,
Yeah.
you and I share the same marketplace. I mean, we're in the DMV, and I have access to the MLS that is really in the Mid-Atlantic region, which includes New Jersey, Pennsylvania, Delaware, Virginia, DC, West Virginia, Maryland, including the Eastern Shore, which is a pretty massive market. If you look at, our state alone, our small state has over 6 million people. There's only 3 million of them that work. I'm still trying to figure that out, but about 3 million. Anyway, we have a lot of people. Now, of course, young kids aren't working. They're in, but I don't even think that the data from the Census Bureau is even accurate because it seems like we have a lot of people in Maryland that may not be counted. But anyway, the market is terrible. The affordability is awful. We have some of the highest, wages, some of the highest wage earners in the country. We have some of the richest counties. Last week, I pulled up the MLS, and we had some, wise guy in the comments after the show posted talk about. I showed Baltimore County and Anne Arundel County as two markets where in a lot of cases, 40% of specific areas had 40% of the active listings between 250,000 and a million. Of course, I didn't do houses that weren't habitable, but these houses, up to 40%, in some cases, slightly more, of the houses in that market had experienced at least one price drop. Now, that would have been years ago. That just wouldn't be the case. The days on market has gone through the roof. And we're seeing where I just looked at a house in Columbia for clients, which is in Howard County. So this wise guy made a comment and said, well, and the wise guy was a real estate agent, said, well, you're giving incorrect data because you didn't go over Howard County and Montgomery County. And it's the same. So their price reductions just the same in these areas. In fact, I went to a house in Howard County where I showed buyers and it's dropped $75,000 in the last 30 days. And it started out at 675. So when we're talking about, the housing market, what is happening is buyers have basically come to their senses. What we did was we put everybody stayed home. They were getting paid to stay home. They were looking at never going back to work again. A lot of them, in office, and they were looking for a place to get out, a way to get out of where they were. So we basically fueled this market with artificial interest rates, dropped them down to 2.74% as what I saw as the lowest mortgage rate for a 30-year fixed rate mortgage. We gave them a bunch of money in a bubble market where everybody was making so much money in the stock market that mom and dad were gifting to their kids whatever they wanted, whatever they needed. For the first time in 35 years of serving this industry in one aspect or another, I never saw anything like it. It was lunacy. And what makes me absolutely nauseous is when I hear people thinking that this will return. You're crazy. It's not going to return. It's going to go down. It's the only way to go. We have hit the plateau. Parents have said, no, it's enough. Most of them have come to their senses. Yeah, they're still gifting money, but not like they were, because they're concerned themselves, because their house is going to need a roof. And one of the things I want to talk about with you, Rod, after Pam drops off, is I want to talk about why this market is going to head south because of repair costs. Everybody wants to put these narratives that everybody has so much equity in their house, and we can't wait to tap into it and give you a second mortgage so you can continue to spend money. And we even thought about the fact that a house is a depreciating asset that's going to fall down around you when the roof goes out and you can't afford to put a new one on. So we're in this la-la land right now, I believe, that is it's completely derailed, but it's coming back on the track. And we're seeing it. Pam, what you're seeing right now is the result of it coming back on the track. This isn't seasonal at all. We had the worst spring market that we've seen in 50 years. That's not seasonal. That's not seasonal. You take a March, April, and May market and throw it in the garbage can, throw it back 50 years. That's when the market should have been hot. People are stuck. They're stuck right now, right? We're seeing a little bit of activity. They're saying, I saw something on Lance Lambert, and I like Lance. I really do. Lance was on our show. He has, I think his company's called Resi. He's doing a lot of data analytics, all in the housing market. Fell in love with the housing market when he worked for Realtor.com. And he posted on X today. Him and I are going to podcast next week again. But the prices are coming down nationwide. But anyway, he had posted on there that Zillow had published that we would see a 0.9% increase in housing in the next year. And, it's laughable, because even how they come up with their pricing is laughable. What they do is they put these high expensive new homes on the market. And if you want to come up with a median home sale price, or which is, basically the middle price, or you want to average a home sale price, and you only calculate now the ones that have money that can buy, they're screwing the data up right now. They're skewing the data, because you take those higher priced homes and you make those the new houses that you're averaging or you're calculating. It's easy to see where year over year we've had a price increase, but that's not how houses are not fungible, meaning that you can't just take a house and sit it next to a house and determine that that's the price of the house. What we're completely being ignorant to is the fact that, these houses are depreciating because they're not being fixed and they're not being maintained. And we're starting to see that now. How's that for an answer, Pam?
I love that.
Probably never
What
ask
are
me
your?
that question again.
I have a question for you. So, have you heard of
Another
Kamala
one?
Harris? And I
You're going to
question for you.
answer another one? Ask me another one?
One more before I have to hop off. But Kamala Harris had talked about a housing grant that she would want to put in place. I think it's 25,000 for buyers to help with costs. What are your thoughts on what that would do to the market, and do you think that will help impact buyers to be able to make housing more affordable for those who don't qualify or can't afford it?
I'm really glad you asked me that question because that's available now.
Right. Exactly. Yeah, that was my take.
This is lip service. Okay.
Yeah, so my
that's
thing is
available now.
Right, exactly.
It hasn't helped now.
Right. What consumers need is interest rates to decrease so they can afford the monthly. It's not the upfront cost that we see as the biggest hurdle for them.
What they need are prices to decline.
Yeah.
That's what they need. It's not date to rate, marry to house. It's not, look, the bottom line is this. Here's what we know. We know for a decade and probably longer than that, maybe 20 years, the average time someone owns a home, it used to be 7 years. It bumped up to 9 years, right?
Oh, really?
On average, right? That people stayed in their home. Well, we're talking about people that have stability. We're not talking about first-time buyers that have bought a house in the last 5 years that are now waking up saying, why the hell did I buy this house? I am on a busy street. I don't want to be in this neighborhood. I'm now driving an hour and a half one way to work. We're not even adding those things into the mix, right? A 20 million house sales probably of, where we're talking about massive regret, right? Where they're like, if I had more choices, I wouldn't have bought this house. So now we're talking about a position or a transition period where a decline in home prices, which in my opinion has to happen in order for people to be able to buy, because the home price is what matters. You're not selling the mortgage when you sell the house. You're selling the home value. So if you can't pay off the loan when you go to sell your house, does the rate matter or does what you paid or owe on the house matter? Right. So we need home prices to come into alignment, or we need wage growth to go through the roof, which good luck with that. Right. And I've got a slide that I'm going to show you won't be on for, but I'm going to talk about layoffs with the show where wage growth isn't going to go through the roof. No time in the near future. Right. I mean, this is facts here. I don't know why people can't talk about common sense facts. Why they want to talk about, well, if, somebody gets elected, they're going to give $25,000 to buyers. You already have it. We already wrote off student debt. I have a client that I think got almost $50,000 for a student loan payoff to buy a house. I mean, come on, that's what, it's not working. You have builders that are offering 5.5% mortgage rates. They're now offering up to 8% real estate commissions because they're completely, they're not moving. Their houses aren't selling. So, when it comes down to it, that's the problem that we had. We allowed this asset class to outprice consumers. The problem is it's housing. So you're going to have to do a lot more than $25,000 a house. You're going to have to continue to pay people's mortgage payments, or we're going to finally see this disaster show up. It's a can that's being kicked down the road. I do have a question for you, though, before you go. All right, here you go. Let's see. What do we got here? All right. This is from Charlton. Question for Pamela. As a loan officer, are you allowed to ask, and do you ask buyers if they are able to get a VA loan?
Yeah, absolutely. That is the standard question we ask to every single applicant. So we want to make sure that we are utilizing VA benefits. Typically speaking, it is one of the most advantageous types of financing, depending on the situation. So it's always a box we're checking off for them if it's applicable. Absolutely.
Great. It's a good question because I would assume it could be like, agents. We can only ask certain questions.
Now, I would say that not all loan officers may ask that question. That's why I'm a big believer in who you work with. It matters. I've definitely seen loans where I'm like, why did they put you in an FHA loan when you're a veteran? Like I've seen that, on
why
credit
wouldn't
reports.
they? Why wouldn't they? What's the benefit to not?
I don't see any benefit to not. However, they could have simply missed asking that question. A lot of loan officers use online applications where, maybe the consumer just checked that box and they didn't circle back. I complete typically all of mine over the phone by hand. So it could be something that was missed. I really scratch my head. Now there are certain circumstances where a conventional loan or other types of financing can be a better fit. It does depend, but typically speaking, a VA loan is usually one of the best loans out there, especially if they happen to be exempt from the funding fee that VA charges.
Do loan officers make less money if they write a VA loan?
Not in my experience. Now, every company can have a different setup. So it really just depends on the establishment, their compensation package, but not in my experience.
Well, you've been in the business for 22 years. I mean,
so I guess I should say not
in
any of the establishments that I've worked for, but other companies, brokers, direct retail banks, all of them would probably have different setups, but I can't imagine that would be the case.
Yeah. I just know that they, on the real estate side of things, they disallow a lot of fees, or did up until what? Was it this month, right?
Mm-hmm.
Wasn't it this month? They allowed, VA allowed, was it the 12th or 14th? Is that what you said?
I think it was something like that went into play where now veterans can actually be charged agent comp.
Well, they had to do something because of the lawsuit, right? I mean, they had to, which Rod and I are going to talk about.
They were trying not to for a while there. They were pushing back, it seemed, but they did.
Yeah.
Fold on that.
Gotcha. All right. Well, any final thoughts? I know it's 9:00. We'll let you get out of here.
No, I don't think so. I think you're touching on the right subjects. It's good to talk about rates. So thanks as always for having me. I always enjoy hearing your commentary. And thanks, Rod.
Yeah, thank you for answering.
Well, you guys should connect. But before you go, let's look at the poll one last time. Actually, we do like Pam's. Pam's one of the good ones. She definitely does a great job for our clients. A lot of our clients or agents like her. And here we go. Still, we have 746 votes. And no, 64% of you don't believe that rate declines are going to help this market at all. And I'm in complete agreement with that. So thank you very much, Pam. You guys can follow Pam. You can check her out. She's in the description. There's a link to her profile. And you can follow her also on social media. I think is your Instagram public?
It is. Yep.
Yeah. She does a lot of updates, loan updates. So and she is licensed in, her company's licensed in just about every state, right? You can help people all around.
Like 23 now.
How many?
Not all. About like 23.
23. That's
Get them at total, but
all right.
Yeah, a lot. Yeah.
Well, cheers. Have a great night. And you're
right.
going to be leaving it to Rod and I, where we promise we won't talk about you.
Thank you, guys.
You'll still be listening just to make sure, I'm sure.
That's right. I can still listen just because I'm sure.
All right. Have a good night, Pam.
All right. Take care.
Right,
See you guys.
See ya.
All right. Okay, Rod, it's up to you and me, man, to carry the torch from here on out. We do have some comments and some questions. We'll just run through them real quick.
All right.
We have dropping rates will just cause a rush of buyers unless homes available after. And I tell you, yeah, I hear what you're saying, and I think this is the general consensus that people think that dropping rates are going to stir a frenzy. I think that buyers are pretty tapped out. Rod, what do you think?
I think, if the rates drop down to 3%, 2%, then yeah, everyone's going to come back to the market. But I mean, I don't think that's the consensus that that's where they're going to go. So that's half a point, 1 point. I don't think people are going to come flooding back. It's not going to make a huge difference to their payments.
Exactly. Barbara, what about the new law about real estate commissions for this upcoming week? Actually, it is a rule. It is not technically a law that I'm aware of, but there still is a date in where the judge, I think it will become finalized. I believe it's in November, but all the MLSs have already adhered to it. It took place last Saturday. It became a new rule across the country. And basically, it changes that how agents or how sellers compensate buyers. And and this is kind of what the unique thing is not much has changed in Maryland because we have always had buyer agency where we had to have contracts signed by our buyers prior to showing houses. At least since 2016, there was no presumed agent relationship. It had to be in writing. A lot of agents weren't doing it, but it has been the law. As far as our real estate law, the Real Estate Commission, state of Maryland, which is a branch of the governor's office. It's a public protection agency. So we haven't really changed a whole lot. There is a lot of confusion. Agents are confused about it, which means that they're confusing their clients about it. And but sellers, according to our MLS, they paid the listing broker and the listing broker cooperated, but the MLS only required $1 cooperation. But we didn't really see anybody offering $1 for cooperation. Actually, there were a couple agents that were offering $1 cooperation, but it is a new rule and people are confused. Rob, what are you guys doing in Colorado? How is this affecting you?
Yeah, we're pretty much the same as you guys. We've had buyer agency agreements for a long time now. Yes, everything that you touched on is pretty much the same that we were doing here in Colorado. Yeah.
Do you see agents confused?
I have not seen that yet. I think we've here in the office here we go over it all the time, and people have been talking about it for a while. I have not run across anybody on the other side that's been confused about it. I think it's been pretty well explained, so I haven't seen anyone. I haven't run across it yet.
I think the biggest thing is that when a buyer's agent is signing an agency contract where they were really avoiding a lot of it. Maybe this was happening in Colorado too, Rod. You could clear it up, but a lot of times the agent would put 0 in the compensation line of the buyer agency contract, and they would put per MLS. So whatever the MLS was being offered, they were accepting it. That is compensation in full. And by putting 0 in there, their buyers thought that they were free. Until they went to the settlement table and saw things like a $15,000 or $25,000 or $40,000 commission. They're like, "Wow, you made that much money?" So they never really had a conversation prior to them getting that, Alta or that settlement sheet. Were you finding that when you had buyer agency before? And we're not going to talk about commission percentages because it's all negotiable. But did you fill out what your fee was always in a buyer agency form and explain that to your buyers?
Absolutely, every single time, explained the whole contract to them, explained all those fees and things like that. We went over all of that, make sure that they were clear. If they had any questions, I would say, hey, ask me, please. Like that's what I'm here for. If this doesn't make any sense, don't hesitate to ask.
Well, the big thing now is your buyer doesn't know whether you're going to be compensated or that they're going to have to pay
Hmm.
the fee or whatever it is on your buyer agency contract. The buyer might have to cough that up. How
Hmm.
are you having those conversations?
It's a conversation. I tell them, hey, this is what my fee is. This is what I charge. And if, usually we ask the seller for it. If the seller doesn't cover that, then that would come from you. And, it's kind of your decision if you want to move forward with it. But that's kind of, um, how it'll work. And I haven't had anybody, I haven't had any problems with it yet. Um, from the seller side, so I've had a listing, from that side, I've seen a buyer's, what's it called, a buyer's, no, it's a broker's commission agreement or something like that. It's the first time it's a new contract, but I've seen one come through where they want to see what we were offering.
Yeah. Well,
Hmm.
here's what a lot of the buyers are saying. Well, that's fine. I'll sign the form, but if the seller's not paying it, we ain't buying it.
Exactly.
And
Exactly.
that creates this whole new challenges too, right?
Hmm.
Because we have had some buyers where they've said, you know what, I can't afford to pay
Hmm.
anything, and I need the seller to give me money even for my down payment because I don't even have that.
Hmm.
And so it is interesting. But I guess what we really want the public to know is that you have to have conversations. If your agent's free, they probably won't be in business for very long. And that may not upset you because a lot of people don't like agents anyway. But you want to make sure that, when you're hiring an agent, that you have these conversations because we're finding a lot of the newer agents or the agents that don't have good management or training, or just they're lazy. They don't show up at the training that you offer, is able to explain to you what you're signing, or you're going to need to really make sure that you understand it. But a lot of confusion has come about this, but not a whole lot has really changed for us, and sounds like for Rod either. With these, the only thing that has changed, which is terrible, is I never really understood this because what they said is we can't advertise the seller giving, or the broker providing broker agent commission or compensation. We can't advertise that in the MLS, even in our back end, or the public doesn't even have access to, which to me, that's kind of stupid.
Yeah, yeah, no, I agree with that.
It's
It is.
stupid
It is. Doesn't make any sense
because
at all.
because now here's what they said. I think the theory behind it was, well, the agent could shop for the commission. Like, I'm going to show them this house because it's paying more. And I
Oh,
get that. Some agents probably do that
yeah,
or did that. But if you have a buyer agency agreement that explains your fee, it shouldn't matter.
exactly.
It doesn't matter. You just tell them, hey, this one covers most of it. This one doesn't cover any of it. This one covers more than it. Then we're going to not be able to take it because this is my fee and they're offering more, whatever it is. But the bottom line is, why not put it in the back end of the MLS? Instead, what we have to do is we have to call the agent that never answers the phone and say, hey, my buyer wants to know if the seller or your broker is covering any of the fee. It's a mess. Let's take some more questions. Here we go. Barb, thanks for bringing that up. All right, here we go. Markets crash when there are more sellers than buyers. Yes. What happens to the housing market when there are no buyers? Well, there are always buyers. Because what happens is the price continues to go down. So, I had pulled out some old flashcards, which really is, takes me back. Rod, could you pass this is not a trick question. It's not even trying to, could you, if you had to take the real estate exam tomorrow morning at 9:00, you think you'd pass it, both the federal and the state?
I think I would.
Yeah.
I think I would pass it. Definitely the state for sure.
Yeah. Well,
Yeah.
that's a good answer. It's interesting because sometimes I like to pull out the flashcards and ask questions and stuff like that. I'm not going to do that to you. That wasn't a trick. I was thinking though, I was like, man, if I pull these flashcards out and ask some questions, but now I'm not going to do it. My broker exam was a lot more difficult than if I had to go through it. If I was in charge, I would make it like some type of journeyman experience, to become licensed. So I would say you could get your license, but for the first however much time or however many transactions, you had to work underneath someone through an apprenticeship and or be on a team, and that you had to be managed, and connected by the hip to someone that knew what they were doing. But I always said that if I were in charge, by year 5, if you decided that you were going to stay in the business, I would require people to take the broker education courses because it's a lot more in depth. And I had like an outer body experience when I was taking my broker exam. I mean, not that it was terrible, but I was like, they didn't teach me any of this. I mean, it's like, it was like you had to know the stuff inside and out. And I, remember taking the prep class and the instructor like, oh, you're going to see this on the test, and this is I didn't see. That's all bullcrap. It was all lies. I got that. I started reading some of those questions, and I was like, skip, and I did pass. In fact, this is honestly what happened. So I don't remember how long you get, 3 hours or something to take the exam, and I think I used a lot of it, and I passed. So they were asking you some stupid questions on the screen, while it was calculating your test score. Give me a break. They knew it instantly. It was just to try and suck more out of you, trying to get your, opinion on certain things, like answering dumb questions like, do you like a Big Mac or a quarter pounder of cheese if you went to McDonald's? So anyway, finally it said that I passed both, and I just sat there. And I was like, wow, man, that was pretty crazy. And the lady, after like 10 or 15 minutes, said, Mr. Sachs, you passed. You can get up. There were other people sitting there. I'm like, oh, yeah, I know. So that was the funniest thing. But I was just taking it all in. But I feel everybody should take the broker courses because they don't really realize, just the implications of the things that people are doing out there, making these wild decisions on their own. But anyway, but what happens is what started me on that was this question. Because every property has a buyer. And what determines market price?
The buyers, what they're willing to pay.
That's it. The market price is what the buyer's willing to pay. We saw that in this run-up of insanity, was that buyers were willing to pay over appraised value. They were willing to pay more than the property was worth just to say that they bought a house. And they were actually jumping for joy. I won the bid. Man, I gave them 25, 30% more than what they were asking for the house. I had to sign everything away, couldn't get a home inspection, but we got it.
Have you ever participated in the auction, Todd?
In an auction?
Yeah.
Oh, yeah. I've purchased houses by auction.
I feel like that's what was happening. I've purchased an auction too. And I can admit this, that I got caught up in some of that too, where it was like, oh, this is the house that I want, this is the auction house I want. No, I'm going to keep bidding. You're not going to beat me at this. And then I got the house, and I'm like, oh, like I should not have done that. I should have let you have it at that other price, But those things, they worked out. But I think that's what was happening. That human side, that emotional side, of I'm going to win this auction.
I bought a house at auction, and I was actually talking about broker classes. I was in broker school, and I was bidding on this house on an auction, and I bought it. And same thing, I got caught up, and this is way before, the pandemic. And I got caught up in it. Great area. Made a gigantic mistake. I ended up selling it to a rehabber for $20,000 less than I bought it for. I took a $20,000 loss. I bought that house. I went through that house and said, man, what in the world is wrong with me? I said, what am I doing, right? I mean, we've all made those mistakes. Thank goodness it didn't take me out. But we've all been there. And you talk about auctions. Auctions were unrealistic as well. I mean, these investors were going to these auctions, bidding these prices up on these houses. I mean, you couldn't buy them. I mean, investors should be smart enough to not, be that stupid to overpay, where we saw these auction prices go. I did it, but we watched people do even more than that, 100,000 more than what they should have, right? You'll never make your money back on the house. I saw it at auctions. I used to go to auctions and buy a tractor trailer load of building materials when I was in the business, building and rehabbing houses. And I would buy literally every single door I was buying, 4-panel, 6-panel, arch panel, doors, solid core, hollow core. It didn't matter. I didn't care. Pre-hung doors, $5, $10. For years I was doing it. Faucets, vanities, flooring, liquidations. And I had a warehouse and I would store the stuff. And I can remember back in, I don't know, the last auction I went to was probably in 2019 even. And people were buying stuff at auction higher than what you could buy the same thing for at Home Depot or Lowe's. I'm like, what is going on? It's because the people get so excited, just like you said.
Yeah.
Everybody should sell their house at auction. Come up with a I'm not selling fee. You're going to pay for the auctioneer. It's going to cost you, because they'll charge you to advertise it and everything. But come up with your price and see who shows up. Problem is now you won't be as lucky. But I think we'll see the prices are coming down. Here we just did that one. There we go. If housing and the car market collapse, doesn't that count as deflation? 100%, Jordan. Yeah. And what we're seeing, and here's the other thing. Now we're setting new comps. So we have to decide if mortgage rates drop a percentage point. Let's just say they go from 6.5% to 5.5%. Pam said you can get 5.5% now. I know you can. I've seen clients do it. We just had a client a couple of weeks ago got 5.5%. And it was a government program. So these government programs are out there, thanks, Kamala, but they are already out there that, people can get second mortgages, grants, forgivable grants, forgivable student loan balances. It's still not helping. It's not moving the market. The prices are too high for the buyers. But what we're seeing now is as people are taking price reductions, there are new comparables. So when an agent's helping a seller price a house or the seller's doing it themselves, they have to look at the area sales in their subdivision. An appraiser is going to try and find two houses to compare your house to in your subdivision. And you have to be careful when you're doing comparables because a lot of agents even screw this up. And Rod, they will draw a radius and they will pull comps in a radius. You've seen them do that.
Absolutely.
What should they be doing?
And that's subdivision. And you want to get a few houses, if you can't pull a few houses that have sold, a few actives, and then if you can't, then you inch your way out, but you don't start. And then, what I typically try to do too is I don't cross over major roads, so if we have a major street, don't cross over that because those are completely different houses, but I do see that.
Yeah. And that's a problem, right? So now we're seeing that sales are if you're looking at a house that goes under contract today, those comparables aren't going to show up for 30 to 45 days.
Mm-hmm.
Right? I mean, very few settlements happen in 2 weeks. Usually the cash deals, the investor deals, sell quick, start rehabbing. But with retail buyers, consumers that are owner occupants, it's going to be 40 up to 45 days, sometimes maybe even 60 days before we see those comps hit the market. So right about October, November, we'll start seeing these prices on their downturn in the
Absolutely.
comparables. The other thing is the appraisers know it too.
That's funny you said that. I'm getting a lot of requests from appraisers asking me questions about certain houses that I've had on the market or certain houses I've been a part of. So yeah, they do know it. Absolutely.
Talk about it. What are they asking you?
Yeah, they're asking me, about the condition of the house, terms, concessions, because all they're doing, they're just pulling off the MLS, so they can only see certain pictures, you know. So they're just asking more detail, yeah, but just more stuff about what happened with the house. I have
Yeah,
another
so
one.
we see
Yeah.
them being more conservative now. The
Oh,
appraisers are
absolutely,
starting to tighten their belt. So
absolutely.
it is
Yeah, and
100%.
I've had some appraisers, some appraisals not come back, and they've come back, a little lower, 5K lower, 10K lower.
Another pretty much the same. If they cut rates by 0.5%, they will undo all the work they did so far. We are
Yep.
far from fixing inflation.
Yep.
Again, I mean, I don't think that that's going to help. I don't think it's going to work. I do want to bring up, and I don't know whether this causes me to lag, not being in our back building. And if you're just logging on, I'm in the office. I'm not out back. Joe, our producer, is on vacation, and he is still working in the background. Poor guy. He wants to do it, but he's on vacation and he's still working. But that's why I'm not in our studio. A little bit too much for me to do on my own. But I do want to pull up here as we're talking about what this viewer is talking about, saying 0.5 point and will unwind everything that they've done. It doesn't really work that way. We're still in some pretty big trouble, in my opinion, with the economy. I mean, here's layoffs here. If anybody has ever gone to dailyjobcuts.com, I reference them. They get some free advertising from me because I am happy that somebody is putting all of this data together for us that we could look at. But you can go to it yourself. You can just basically go down GM, 1,000 salaried software and service employees being laid off. That was yesterday. You can just cruise through here and see MasterCard 3% globally, or 1,000 employees. You can see Bass Pro Marine Division 100. You can go through. These are by the day, guys. But the biggest thing here I want to look at on the right-hand column are the closings. This is crazy to me. You can go down through this list, but what I thought was really disturbing was Rite Aid. Here you go. August 17th, and this is by the day. Rite Aid closing all Michigan and Ohio stores, a total of 417 stores. Guys, go to this website and check it out and see for yourself what is going on. I mean, this is just the beginning.
Yeah, that's crazy. I never knew about the website. That's a pretty cool website.
I mean, it's kind of doom and gloomy right now when you look at how many people are laying off and what businesses are shutting down, but I think it's the reality of things. So when we're talking about 0.5 point rate cut, it's not going to unwind anything. I sat down. I have a client of mine. I have sold several houses for her. Her dad was a real estate investor. Unfortunately, he passed way too soon. and I was working with him and then the family in selling properties. In fact, they could even be listening right now. But we had a meeting yesterday where it's in her blood. Her family's been real estate investors forever, and she has someone that she's working with that they want to go in together and do some investing. And we had a meeting, and I said, look, this is not the time to buy anything. I mean, you're at the top of the market and still, and we have yet to see what is going to happen in this market with price reductions, in my opinion. And they were kind of let down that, you can't find any deals out there. And the answer is no, because we don't know where the bottom is even going to be even close to. So when we were looking at, one of the things, I had a great interview, Rod, and I don't know if you've ever seen any of my interviews with John Rubino, but John's been on the channel a bunch of times. He wrote about the housing market crash. I think it was in 2003, 5 years before the housing market crash really showed up. It actually started in 2005, so he wasn't far off. But we were talking about the difference of the markets, and that video actually comes out this Saturday. But here's what he told me, or what he was saying, that was an eye-opener to me, and I've been in the business for 35 plus years. But what he said was, right now, and we all know the bubble is way bigger than it was in 2000, leading up to 2008. 2006 was the existing home peak. But what happened then was really obvious, because we had never seen anything like this before. So there weren't systems in place to get in front of the housing market crash, right? The government was caught by surprise. Bernanke was the Fed. He even said, housing market, the banking industry is strong. But what happened in 2008 was we saw a line, just a direct drop line, just a massive fall. All of a sudden, it happened all at once. So we watched the bubble go up, it popped, and it went directly down. The difference now is that the bubble grew much bigger, so I believe it's going to be much worse than 08. But what happened was the Fed got in front of it. The Silicon Valley Bank would have collapsed on the March 12th weekend March a year ago, was the third largest bank failure. That would have been disastrous. But in one weekend, they cured that default. And then every collapse thereafter, they protected all of the depositors, not the investors, but the depositors. That was just one line. Then by setting up all of these programs, saving over 1 million homeowners and counting from foreclosure already. So what we've seen is it went up, and now it's kind of leveling off. We haven't seen that event to where it starts going down. It would be impractical and unreasonable to believe that it won't. If we believe that it's just going to level off and everything's going to be fine and it's going to continue to go, we know that it won't because of the debt. We know that it won't because of wage growth hasn't kept up. We know that it won't because of, employers not doing well now. We know that it won't because home prices have maxed out buyers' ability to buy. So it's just stalling right now. So John really kind of opened my eyes to, wow, that's really true. So you were ready as an investor. You were like, oh man, it's dropping so fast. I can buy today at 6-month prices, prices from 6 months down the road. I could just offer them some crazy, ridiculous price because they're losing their house, and they're probably going to take it, and their bank's going to take it because the bottom's falling out of everything. We haven't started that yet. So it's a very risky time to jump in as an investor. And what I said to them, because they were deflated, is I said, don't worry, it's not all of a sudden going to go up. Everybody feels that as soon as something, they're already sitting on the sideline right now, just ready to jump back in at a 0.5 percentage point. That is what people are seeing. You see it in the comments. That's what they're thinking. A 0.5 percentage point, my gosh, I need to act now. Well, that's what they want you to do.
Mm-hmm.
That's not going to all of a sudden increase or change anything than it was a month ago or 6 months ago. It's going to take time. So if you're sitting on the sidelines, you could probably feel pretty good there, knowing that even if they drop interest rates a point, you have time. You're not going to see an instantaneous mad rush because we've already tested it. You heard Pam say it. We've tested it out already.
Mm-hmm.
We're already in the 5s. We can get in the 5s with borrowers right now.
Mm-hmm.
It's not working. So I think everybody just needs to calm down. Rod, do you agree with that? Do you disagree with it? What are your thoughts? Talk about this.
I do agree with that. I think that we see that here where, like I was talking about earlier with the 2-1 rate buy downs, that's putting people in that 5.5% range, and it's still not, pulling this inventory, not inventory, but pulling these buyers forward. We've already pulled those buyers forward when we had the low rates of 2.5% and 3%. All those buyers came forward. And I do think, right now, like you're saying, there's a lot of FOMO. People are afraid because they might have lost out in 21 and 22, and they don't want that to happen again. They don't want to be 35, sharing, a room with roommates and things like that. And, so they're processing all these different things, and they're panicking, and they want to jump back in. But like you said, that's what they want, and I think that's where it's important to get with the right person, to talk to them so they can give you those numbers and give you those stats, and you can see like, oh, I don't have to rush back in right now.
Yep. This is sort of along the lines of what you're talking about. Isn't a buy down effectively a version of an adjustable rate mortgage? Do you want to talk about that?
Yeah, yep. I think it is I think it's a version of it. I have tried to steer, not steer, but I try to, help clients, when they're talking about doing, rate buy downs, and just kind of give them the information and tell them, this is what it's going to look like, and 2 years from now, yeah, you're fine today and you qualify for it today, but 2 years from now, you don't know what your life's going to be like. You don't know what grocery price is going to be like, gas price is going to be like, and you get comfortable, right? They get comfortable paying that 5.5 today. Now it's going to go up 2% in 2 years, and they're like, oh, now I'm paying, I don't know, $300-$400 more a month, when they've gotten comfortable paying $300-$400 less, and I try to point that out to people. Not everybody, listens to that, right? And I think part of that is because they are, FOMO and things like that.
Yeah. Well, and just to kind of explain to people what happens in a rate buy down. Because Rod's right. I mean, essentially it is, when you look at it's an adjustable rate mortgage, it's to the buyer, essentially it is, because it's an adjustable payment mortgage. Mm-hmm. But what happens is, in order to do a rate buy down, your interest rate's actually the same. But what happens is the seller or somebody is prepaying your interest on those years that are where the payment is lower. So if you have a 7% loan, you have that from day one. So technically your rate doesn't change, but it is almost like an adjustable rate, because your payment, like Rod's saying, adjusts. So what happens is the difference between the rate buy down and the real rate. So a 3-2-1 or a 2-1 buy down would mean that the first year somebody's paying 2 points of that interest rate, and the second year in a 2-1, 1 point of that interest rate, they're paying that ahead of time in order for you to have lower payments. The problem is that the rate's the rate, and at the end of that time period, you're paying the difference in money. And, you know, one of the things that we haven't spoken about too much, we touched on it earlier, is one of the biggest reasons why I think home prices are going to come down. Because a lot of people, whether you want to talk about, you know, inflation adjusted, or, you know, with money, and, you know, how some people want to say, you know, your dollars, you know, deflated away, which it is. But I'm talking about real prices, right? And why I believe that we're in for price decline is because the home price repairs and replacement costs are so high. So your insurance is based on replacement cost, and your property taxes are higher based on your purchase price or the prior purchase price or value of the house. And now repairs are going to matter even more, because as we were coming up in this 4-year period from 2020 through now, where they're, you know, still claiming that home prices are increasing. They're not calculating, right? But just stay with the narrative. The issue is we have seen 100% price growth in a lot of cases on repairs and maintenance to a home. At least 40, 50, 60, 100% price difference. We have a restricted, capable labor pool, right? A lot of the, the small contractors that are good, they're busy and they're charging through the roof, through the nose for repairs. And a lot of that's because their costs have gone up. They've had to hire more expensive, capable labor. Their insurance has gone up for their business, or they've been canceled. And, you know, their truck repair costs have gone through the roof. So look at all this inflation-based, you know, we're not even talking about this, right? Talk about eggs and milk and bread. Look at the cost of contractors, their workers' comp insurance, and what they have to pay in order to even bring somebody out to your house. Now, the price increases of all the building materials has gone through the roof as well. All your petroleum-based products are, you know, siding, roofing, you name it, right? What's happening is now these homes have been sitting on the market. If you buy a brand new house today, you can plan on about 7 years living in that house before you have to start spending money. Then you're going to start spending money, right? Things are going to break. Appliances are going to go up, right? You're looking at, you know, life expectancies of water heaters being, you know, maximum 10, 12 years. You're looking at new HVAC systems are junk today, what they're making. These products are junk. These high efficiency, it's all junk. These things break down 12 to 15 years replacement, right? That's the life expectancy of your HVAC system. Your roof, you're going to get 35, 40 years, okay? And depending on where you live and what kind of climate you have and how hot it is and how much wind you get, your appliances, your dishwashers, maybe going to last you 3 years. They're junk, right? Your refrigerator, if you're lucky, you're going to get 10 years out of it, right? These aren't like the old refrigerators that you had in grandmom's house that were 30 years old and still running. These products break. These washing machines break. This electronic crap breaks, right? So what's going to happen is now people are living in these houses. Now things are breaking, right? Now expenses are coming. Now people are getting, they're getting what? They're getting home inspections. And now they're going to have to fix things. Well, what's going to happen? If you want to sell your house, you're going to have to fix it. There are certain things that you can do if you live in a house you cannot fix. If your windows go bad in your house, And they have, depending on where you live, different climates, but they have argon gas, filled windows, high efficiency, energy efficient windows. If they're newer windows, the seals break and they get cloudy inside. The cheaper windows, they break quicker than the nicer windows, but they all break. But you can live with that if you're a homeowner. If you put the window up and it doesn't stay up and comes down and slam down on your head, if you're sticking your head out there or your hands, you can live with that. You're not going to live with a roof leak. You're going to have mold inside. It's going to destroy your house. It's going to be a disaster. You're going to be an eyesore in the neighborhood, but you can live with your gutters falling off your house. It may cause you to have a leaky basement from time to time. But when you go to sell that house, you're not going to sell the house for top dollar, right? So everything's good until we see these houses hit the market, and that's going to drop prices. The distress is increasing, guys.
Yeah, no, that's a really good point, and I can give you a personal example, with people not understanding those repair costs. So we sold a home about 3 years ago. The buyers did their inspections and due diligence and all that stuff. Um, Last year, late last year, they reached out to their agent and they said, "Hey, look, the buyers that sold this stuff knew that there was electrical panel problems and so forth and so forth." We put everything on the disclosures. We didn't know it. There was no problems that we knew about, right? But what this person was probably trying to do is they probably realized some of those costs, right? Like, oh, this electrical panel costs 2 grand to fix or to add or whatever. I don't know what work they had done, but they probably realized those things, and then they tried to come after. And then, so basically my attorney was like, oh, like, tell them to kick rocks is basically but but they were fishing, and that's what people, not realizing these costs.
They do it all the time, right? I
Hmm.
mean, they come in and a lot of it's their agent's fault.
Hmm. Yep.
I mean, we don't want to say that. The first thing we want to say is, well, the buyer makes the decision. Yeah, that's true. But how
Yeah.
many of them have been pushed?
Mm.
Their best friend in college. They don't know. They buy the house, they bring dad in. Dad doesn't know what he's doing. It looks good. And he asks a couple questions, but he doesn't have a clue.
Hmm.
Well, dad takes his credit card out because something needs to be done.
Hmm.
And the kid can't afford it.
Hmm.
I mean, that's, and that's the sad part is we're not getting inspections. I have courses that I'm coming out with right now, Rod. It's not going to be very popular with agents. I have to be honest with you because we're going to be teaching the consumers how to be smarter than their agent in most
Mm.
cases. And in fact, it's probably one of the most comprehensive courses ever written. And we're going to have printouts and all kinds of things that people can take with them when they go. Get ready, agents.
Mm.
When you see your buyer show up with a checklist when they're going through the house, you'll know you can call me up and thank me for it. Because it's going to, it's things that people don't realize. And I tell you, and I'll just give you a little hint. Most people don't even realize what the neighbors are like.
Mm.
They buy the house, dogs are inside. Every time they go, they find out, well, the neighbor has 14 barking dogs, man, and one of them likes to jump over the fence 3 times a day. Like, man, I had no idea. Another one is traffic. People
Oh
go
yeah.
and they look at the house. They don't realize that
Hmm.
Saturday it's like, a thoroughfare,
Hmm.
right? And it's bumper to bumper traffic in front of their place Saturday and Sunday. I mean,
Hmm.
it's just, it goes on and on and on. People making these very expensive purchases. And
Yeah.
and most agents, the bad agents, they don't like me very much, and that's okay. I don't like them, so that's that's all right too. But my purpose here is to educate as many people as I can.
Hmm. And it'll be
You know,
helpful. It's going to be helpful, for those people that do have bad agents that maybe, here's what I'm seeing, I guess, because here's what I'm seeing also. I'm seeing agents do this part-time. I mean, agents have always done it part-time, but where they have a full-time job and they're kind of doing this on the side, so they're not keeping up on things, they're not following things. So something like that will be beneficial to that buyer, and I'm also seeing agents get out of it completely. But yeah, that's going to be very helpful for those buyers that's with an agent like that.
Well, the thing is, it'd be good for agents too. See how many agents, step up
But they would have to
and
take the time, though, right? The agent would still have to take the time to learn that, and I see that that's part of the issue too. Is that this isn't? I don't think this is something where you can just go out and you're like, oh, I'm just going to go sell a house. I'm going to go list a house. Like you actually have to put the time in. This is a business. You have to continually educate yourself, not just on the mandatory stuff, but above and beyond that. Not just baseline. Let me just keep my license afloat type deal.
yeah, yeah, 100%. Here's one for you. This is one of our broker referral agents in Florida, Phil. He now goes by Pizza and Real Estate. He's got a pizza truck it
Oh,
looks
nice.
some wood-fired pizza. It looks pretty
Oh,
good too.
nice.
Anybody named Simonetta from Philadelphia, man, you must know something about cooking some Italian food, right? So I believe rate drops could possibly have more sellers get on the market. If sellers get close enough to the current mortgage rate, they may try to cash out, could lower prices. Any thoughts on that, Ron?
Yeah, I think it depends on the equity that they have. I saw a couple of houses where um, there's one. So there's one that pops into my mind right now. They bought for 400 last year, and they are asking for 50 now. They're needing to get out of. I mean, I mean, we haven't appreciated 12% in over a year. We're actually heading the other way, right? You know, um, so I think some of them going to do it because they have to do it. They don't have a choice. But yeah.
Well, this is where the price of the house is more important than the mortgage rate, right?
Hmm.
Because there doesn't matter what their mortgage rate is, they're underwater. So they're
Yeah.
probably not going to sell it for 450. They
Hmm.
paid 400,000. They probably spent money on the house in the last
Hmm.
however long that they've been fixing or doing anything to the house. If
Hmm.
anything, maybe they didn't, but they have to pay real estate commissions,
Hmm.
transfer recordation fees, right? So I mean, they're going to be expenses that they may have to give a buyer a contribution, a
Hmm.
percentage of contribution for the buyer to even be able to afford to buy the house.
Hmm.
So, and then they have to hope that it appraises the 12%.
Exactly.
You're not saying that it appreciated. So they have that, right?
Hmm.
But here's what I think we're going to see a lot of where Phil, a lot of Airbnb owners are at the point of liquidation. They're ready to sell. I think
Yeah.
rates dropping, putting the hopes to put more buyers in the market and trying to time the market when rates come down, because a lot of people are like, man, if I put it on the market right now, I'm probably not going to be able to sell it for the price that I want for it. But if rates go down, I might put it on because there might be more buyers out there. So even, not saying that it would be closer to their mortgage rate where they would want to cash out, but just that they feel that there may be more buyers in the marketplace. And I think that's where they're going to get hooked and it's not going to happen. I think they're going to be tricked. They're going to be like, oh, interest rates are dropping a full percentage point from where they were 2 months ago. I better sell now because the buyers are out there with these lower mortgage rates. And I think what we're going to see is that will cause an influx in inventory to hit the market. This Airbnb situation out there, I think, is really what happened was this. The Airbnb buyers are very capable financially. My experience with Airbnb is that we're dealing with people that have wealth, right? Maybe you know, somebody has a, white collar, high paying job, and the spouse says, hey, I'll run it or manage it. or whatever. Let's buy this, or let's buy a vacation property. We'll rent it out and we can afford to have it. So I think a lot of the reason why we haven't seen this inventory hit the market is because it's a very wealthy buyer. And the reason why it's easy to figure out why it's a wealthy buyer, because you have to put about $30,000 or $35,000 in the house after you buy it. You have to put furniture in the house, and a lot of it is high end. If you ever stay at these Airbnbs, I mean, they're pretty swanky. They have everything from a pizza cutter to a cookie cutter. It's like everything. They don't just have one coffee maker. If you want drip, you want a Keurig, you want whatever. They want to try and be accommodating. So they've dumped a lot of money in their Airbnb, right? So they bought these houses, they outfitted the houses, and now all of a sudden they're like, it's not as profitable as we thought it was. Not only that, Airbnb fees are outrageous. I mean, even VRBO, any of the short-term rental places are taking fees. They either charge where Airbnb charges the tenant more, the guest more, VRBO charges the landlord more, or the host more. And what happens is, we're seeing their rates. They're having banner years. Well, of course, they're raising their rates. What are they going to do? They have the platform. It's like Google, right? I mean, they could charge you whatever the heck they want for ads. They own the platform and the people. So they basically name their price. Well, people are realizing that that's dipping into their profits. The ones making the money, billions, is these short-term rental platforms. But costs have gone up. Insurance has gone up. Taxes have gone up. HOAs have fought against them. The townships, cities, and counties have outlawed them. They said that you can't have short-term. You got to have at least 30 days, or you can't have them at all, or it has to be 6 months, whatever. The neighbors hate them. It goes on and on and on, but these are a lot of houses. And I think what we're going to see is when interest rates drop, they're going to believe fictitiously that buyers are going to come out of the woodwork. They're going to think they all have money like they do. They're going to flood the market with these houses, and it's going to make it even worse because we're going to see more competition for these stressed out, drained down borrowers that have hopefully learned a lesson over the last 4 years. If this pandemic boom had been 20 years ago, we may have enough amnesia. But I think now, with it being so close in time, a lot of people still remember the bad decisions that their friends made, and the complaints and the struggles that people are having right now. That I don't think personally that it's gonna work out.
Yeah, it doesn't seem too promising, right? If we have the Airbnbs plus, the people that's going to come on the market when rates drop, plus layoffs, plus we already don't have a ton of buyers already, right? So where's the market going to be heading?
Yep. Question: how many people are still on forbearance during the 2020 to present time frame? Seems like foreclosure should be rising, but not probably because banks are not following through. And this is right on the money. Are you seeing many foreclosures in your area?
I'm not seeing many foreclosures. I am seeing people underwater. Like I was talking about that property earlier, I saw another property where they've been trying to sell this property for a year and a half almost. They started at 575. They have dropped it about $150,000. You know,
575 to 4.25.
still in the market. Still in the market.
Not even working. It's not
No,
even getting the job done.
no, no. So, and I'm also seeing a lot of corporate homes come on. Some of these corporate investors that bought, oh, it's crazy. They bought so many homes here between 20 and 22. Thousands of homes they bought. And, you look them up now and they are putting those houses back on the market. And they're putting them on the market at a loss. But for them, they bought these houses cash. They don't, I mean, and they have investors to answer to. But to answer the question, I'm not seeing those foreclosures, but I am seeing people underwater. But it should, right? I mean, they should be foreclosed on, or it should be happening. It's just not.
These investors bought it with OPM.
They sure did.
That's other people's money, folks. That's why it's called investing. There's risk in investing. You know, a lot of these,
Yeah.
operators,
Hmm.
they raise money to do a lot of the investing. These corporate operators, and a lot of times they sold the house. They got their profit up front. So they bought the
Hmm.
house for 400,000. They sold it to their investor group for 450. They made a
Hmm.
$50,000 slice off the top, and a lot of them have management companies.
Hmm.
So when you look at a lot of these fractional ownership type owners, they're managing the rentals, and they're charging a fee on that too. So they're sort of protected. So if they dump and run, the ones holding the bag always are the ones that put their money up
Hmm.
and didn't have any say in the way that things were ran.
Yeah.
That's sort of like it being a taxpayer. That wasn't nice, was it? That wasn't. They let us think we have say, right? Yeah, forbearance is still an issue. I mean, we know people that are living in a house for years without paying payments, and what's happening is Fannie Mae's bundling tens of thousands of these loans already, and selling them off to institutional buyers, and for less money than what they're owed. And certainly when a lot of these institutional buyers, when they buy these non-performing loans or reperforming loans from Fannie Mae, they don't have quite the same guidelines. Now there are guidelines that they can't just swoop in and kick them out and take the house if the forbearance, or if they continue to not perform, or the reperforming loans start to not perform. They can't just go and kick them out. But they have a lot less regulation, and it's a lot less dirty for the government-sponsored enterprises to be the ones that's kicking them out. Right now, it's the new owners of the loans, the notes, the new investors are the ones kicking the people out. So it'll be a different scenario. But what we've done is we've extended this long enough to hopefully get past the November election. And once that happens, well, we'll see. Then the inevitable, folks. Hey guys, we may just be hearing, hey, well, it's just been inevitable. We've tried so hard and for so long, but now we've got to pay the piper because we've got to get ourselves out of this mess. So it may be a complete different story come January of 2025. And my brokerage, the listing agent, is not authorized to offer compensation. Only the seller is permitted to offer it. If they include it in the offer, make it a contingency, then we reject it. I'm seeing, actually, Matthew, thanks for bringing this up. In fact, I think Phil, we just talked about Phil down in Florida. I believe that he is setting it up the same way, where he's refusing to participate in what Matthew is talking about here. Is in our listing agreements, the way it has historically been, and Rod, you know this, the seller pays whatever's negotiated with the listing broker. Now, I want to clear something up. States may be different, state laws may be different, but when we think about an agent and a broker, an agent is an agent of the broker. They're acting on the behalf of the broker. So when we're throwing terms around like agent and broker, at least in Maryland, the broker owns everything, right? The agent really may be running their business in a business, but what happens is all the payments go to the broker. They don't go to the agent. The agent will get arrested and locked up. It goes to the agent. They can't take a commission, right? It has to go to the broker, and the broker then pays the agent, okay? So when we're talking about a listing contract, with a seller and a listing broker. Doesn't matter who your agent is, who shows up at the door, who promulgated the whole thing. That agent is acting under the brokerage. Okay. So the way it has historically been is that the seller pays the listing broker, and in the listing agreement, the seller authorizes the broker to cooperate with a buyer broker. No matter who the agent is, the payment goes to the buyer's agent's broker. Make sense? So here's what happens. It's been that way forever, as long as I can remember. Before buyer agency, it still went to the other sub-broker. I don't want, that sounds too confusing to get into with you guys tonight. But my point is, what he's talking about is that his brokerage is not allowing any payments like that ever to happen, where it's still allowed on the listing agreement. It could still, a seller could still traditionally pay the broker, listing broker, and the broker can pay the buyer's broker a portion of their fee per the seller's permission. What he's saying, he's not going to allow it. He's going to make the seller pay the buyer's broker's fee if the buyer broker is going to be compensated at all by the seller or the selling side. This is the problem that I see with that. How is that going to be put on the settlement sheet? Because if it is a seller concession, there are limits to what the seller can receive in percentages of concessions to be in conformance with their loan. That's the snafu. I mean, Rod, does that make sense to you?
Yeah, I get what you're saying. Yeah, I was trying to, my wheels were turning trying to figure out how that could work. You know, how you could do that.
It's a lender question,
Yeah.
right? It's a lender question. Well, anyway. All right, we do have a super chat here I want to bring out here. Thank you so much for your super chat. Hi, Todd. Should the market correct to cause underwater mortgages? Should the market correct to cause underwater mortgages? Do you think owners will walk away or stay with the reversal? I mean, this is what we experienced in the crisis of 2008, because a lot of people walked away from their mortgages and they could afford to pay them even. But when the prices dropped so low that their neighbors were buying the same house as theirs or similar house or nicer house than theirs for $150,000 less, the homeowners gave up and said, screw this, I'll just let it go. I'm not going to pay this mortgage. And I think that's the problem, is a lot of us have become, and I'm not judging you, I'm just stating a fact, a lot of us have become, I guess, ignorant to what we agreed to. The bills that we signed up for, the student loan that we agreed to. We don't want to pay them. We sign contracts and we don't want to pay them. So the question is, will the owners walk away, or will they stay committed to what they purchased and continue to pay the bill no matter if their home value drops or not? And that's a good question. Don't know the answer to it. Time will tell.
I could see a lot of people walking away, like they did before, because, it's kind of people going to make that financial decision, like you said, of, do I want to pay this extra $150,000 when I can go down the street and buy it for less and save money over the long run? Like, that's 150, that's a lot of money to, so I could see people running their numbers and be like, yeah, I'm just going to walk away from this thing. Here's, bank, here's the keys back.
And I'm not judging you. If that's
Hmm.
if you do that, I mean, that's up to you. But I think it's becoming more and more easy, or easier more and more, for people to do stuff like that, because we get into these situations where we don't want to own them. We don't want to own up to the commitment and find a way to pay the people back
Hmm.
that decided to give you the money in the first place. I have a
Hmm.
lot of friends that aren't friends anymore that are like that. You know, I had a friend of mine say, look, if a friend borrows money, just kind of decide, if you're going to lend them, depending on who the friend is, if you want to just lend them a fraction of what they want, and you'll never hear from them again. I mean, there are those people out there, right? They'll never call you anymore. They won't ask for any more money because they'll never pay you back. I mean,
Mm.
I think that the more and more as we, go through the years, the lack of commitment, the lack of, you know, um, a handshake means nothing anymore, right? So we get in these situations like, if it doesn't work out, I'll just walk away from it and let it go.
Hmm.
Next week we have one of our audience, one of our viewers coming on with us. She teaches in California. She's a professor, and she wants to talk about how student debt. It's unconstitutional because they now allow student debt to not get canceled in bankruptcy. And I mean, we're going to have I know it's going to be a great conversation, because we're going to be talking about some critical issues that, like student loans and the cost of education in America, and is terrible, and why that happened. I mean, all you have to do is know that the government started buying all the loans and allowing students to, go for free to colleges until they get out. And then all of it catches up to them. Well, you don't really think about it. If it's free for the 4 years that you're going, you don't have to make any payments. Gee, that's kind of no brainer, right? Well, yeah, it really is important, because most people can't pay it back.
Hmm.
So, same kind of thing. But anyway, here, Matthew, one more plug here for his brokerage. So many brokerages are not interested in training their agents to the new policy. They're terrified they're going to lose them, so they don't train them. They aren't getting it. This has been one of my biggest pet peeves with the industry, is that most brokers do, I won't say most, but many brokers do a lousy job of training, and they don't, agents. I had one of my agents not that long ago, as a newer agent, and he said, look, I'm going on vacation. I'm going to miss the sales meeting. We only have them once a month, for crying out loud. The rule is that they need to come to 6 of them. You should, a broker needs to train at least 6 times a year their agents, or they can be charged with failure to adequately provide, or failure to provide adequate supervision to your agent. So it's kind of hard because they're self-employed people. So, there is a internal revenue code that does allow, in this case, for, a non-employee to be told that they have to do certain things like training, where in a lot of independent contractor situations, employers don't have that authority. But what we have really let happen. So this agent was going away on vacation. He said, hey, can I Zoom in? And I said, no, it's not allowed. We used to do Zoom through the lockdowns. But I said, no. And he said, well, why not? And I said, because if I allowed Zoom, we'd never see any of our agents. They wouldn't come in. And they would be turning their cameras off, getting up, going and getting a coffee, going to the bathroom, walking the dog. Their ADHD would kick in. They would be talking to their neighbor. You wouldn't see them. They'd be logged in, but you would never know what's going on with them. And so it's just a decision that we made, that we're not going to allow it. You have to come. If you can't come to a 2-hour meeting once a month, we don't need you. And, brokers need to stand up on that, and they have to know that they may be in contempt of federal court if they don't follow these rules. So, all right, Rod, any final thoughts? We sign off here.
Yeah, I guess, I'll show a chart with you guys real quick with everyone out there, just kind of see where our market is. I don't know if you guys can see
We'd love to see it.
this. Let's see here.
I can't see it. There we go. All right.
All right, somewhere in there. I'm trying to get
That's
it.
inventory line, the blue line.
The blue line is inventory. I'm trying to get this centered. All right, so blue line is inventory. Red line is sold, right? So this goes back, I did back to January of 2022, because
Wow.
that's when the market shifted, right? I mean, well, that was the year start to shift. But you can see where sold was above inventory at the beginning of January of 22. And then once we hit June, how that line switched. But look at where we are today, though, with this
Yeah.
inventory. Our inventory has
Yeah.
just completely climbed.
Skyrocketing.
Whereas these solds they've come down also. They kind of come down and kind of flatten out. But that's kind of where we are right now. We're up for July. We're up 1,000 homes year over year. This week, we had 410 new homes with about 260 sold or something like that. So we're still having inventory come on,
Wow.
and we're still having sellers that are stuck and they just will not budge on their prices. And buyers are like, well, I'm not paying that price. And it's like what we talked about earlier is buyers are the ones who determine what a house is worth. That's what a house is worth, what a buyer's willing to pay. And buyers are just saying, nope, we're not paying that. And sellers are just digging in their heels and saying, we're not lowering the price. Not all sellers, but some sellers are just digging in.
Well, they're not going to sell it.
Hmm.
Days on the market is not a seller's. It's not a seller's friend.
Hmm.
It really isn't. I mean, you put a house on the market, it should be ready to be on the market,
Hmm.
right? And it should be priced right for the
Hmm.
current market and a little bit lower than where it should be to
Hmm.
still get the multiple offer situation. And that's what we see is a lot of people will say, well, multiple offers are still happening in my neighborhood. Well, it was probably an agent that priced it right.
Hmm.
It was probably a smart agent. You should probably, hire them if you're going to sell your house. If an agent's still getting you multiple offers in today's market, they're doing something right? Unless they're complete idiots. Now,
Yeah.
I mean, they could underprice it. If they underprice it by $100,000 and they're, depending on the price point, but if you're at a $500,000 house and it goes for $100,000 more, don't hire them.
Hmm.
Because it probably was priced too low,
Hmm.
and who knows what it should have been priced at,
Absolutely.
right? But if they're getting their comparable price plus, it's because they're doing something right. So,
Hmm.
it definitely, yep. All right, let's see here. Let's pull up the poll one more time before we get off here. All right, 1,149 votes. The answer is, guys, I think you're smart. You're right. 63% of you, or at least 63 plus 21% that aren't sure. Honest answer right there.
Yeah.
Believe that lowering mortgage rates is not going to prevent the housing market crash. Guys, we love you. You're the best audience out there. I'm sorry tonight for the glitches, any glitches that we've had. Like I said, our producer's on vacation. He's still in the background helping us out here. We're very appreciative. Thank you, Joe. We want you to get to your family and back and enjoy your vacation. Rod, as always, my friend, it's a pleasure. Anybody looking in Colorado Springs, Colorado, all of Rod's information is in the show notes. He's a great guy. We wouldn't have him on our site if he wasn't. And he's very knowledgeable, more than 15 years in the business. And, man, I just can't thank you enough.
Appreciate it, Todd.
All right, guys. So until next time, hey, send me those emails, guys. I promise you won't be spammed, and I'll never share them with you. But we have a link in the description below. There has been some of our videos that hasn't been shown, if you get what I'm saying. I don't want to use that word on the platform. But for some of the things that we're talking about is not the highest in popularity with this, some of the things that are going on. And it is not getting to our viewers. We've polled them. They've said, hey, this video didn't show up. We're trying to make sure that you're notified every time that we post a video. In the description, a link straight to sign up for our email list. When we do post a video, give me your email that you look at. Don't give me your Mickey Mouse and Donald Duck Club email where you never look and you give it to all the people that you think are going to spam you. Give me your one that you look at so that I can send you, a little note when we post a video so that with a link to it that you can watch it and not have to depend on the platform to pull it up into your suggested or recommended videos. But anyway, good night. We love you guys. See you next time.